think about saving for your retirement through 401k plan or 403b plan, the two key assets you would invest are government bonds and well-diversified stock portfolios. And one key consideration is how do they co-move with each other. My name is Andrei Ermolov. I'm a professor of finance and business economics at Gabelli School of Business. In financial markets, some investors are willing to pursue high returns, and for that they're willing to tolerate a lot of uncertainty about their portfolios. But a lot of other investors, they are more risk averse and they're willing to forego some of their returns. For example, okay, you hold stocks in your portfolio, say S&P 500, and you add government bonds. If government bonds move in the same direction with the stocks, then this will increase the volatility of your portfolio. But if they move in different directions with the stocks, then this will decrease the volatility of your portfolio. I developed a mathematical model which would generate this time-varying correlations between stock and bond returns and the data on inflation and consumption growth in the US. And I fed this data to the model, and then I compared how well does this model predict a pattern matches. What we observe is this co-movement often changes. Sometimes they move together, sometimes they move in opposite directions. I show that a part of this co-movement can be understood through macroeconomic shocks. They're not symmetric, in particular through the way economic growth and inflation move over time. So for example, a large negative consumption growth shocks tend to occur much more often than large positive consumption shocks. This particular asymmetry in shocks tends to be a very important feature of my paper, which distinguishes it from the earlier literature, which actually finds very little connection between macroeconomic factors and stock and bond return co-movements. Macroeconomic shocks are able to explain the variation in stock and bond return correlations during many historically important periods, such as the Great Recession of 2008-2009. They also explain high correlations which we observed from the late 70s to early 90s. But of course, this is only the first step. There are still many unexplained episodes which we don't understand, so it is a very active area of research because it's of great practical importance for both institutional and individual investors.